Welcome back to Investing Wizards. I have the pleasure of having Mike Singleton, who's the founder and senior analyst at Invictus Research. Welcome to the show, Mike.
Thanks for having me, Rob.
So tell us to begin with what Invictus is.
Sure. Invictus Research is a provider of macroeconomic research. We focus particularly on studying the business cycle. And there was a recent study by S&P that just came out in the last year or so that said about 50% of price action in stocks is attributable to the business cycle. And I can tell you that in bonds or commodities or currencies, it's a lot more than 50%. It might be everything in those cases. And so even if you're just an equity guy, you really want to understand the business cycle, or you're missing out on sort of half the reason why stocks move. So that's what we study here at Invictus, and we focus on understanding where we are in the business cycle and then communicating that to our clients in sort of short, easy to understand videos.
Cool. I started following your research recently, and I think it's great. I think it's such a powerful combination of top-down and bottom-up views. So why don't we get right into kind of how you're looking at the market? So let me share my screen, and we'll go over some of the themes and trade ideas that you're thinking about.
On a high level, the way we think about markets, we have sort of a two-part forecasting process. The first is our bottom-up fundamental outlook, and we sort of arrive at that through a combination of understanding economic history and the high-frequency data that we collect, and base effects, and Excel models and all of that stuff. And the second part is sort of the market's response to that. So we have our fundamental forecast, but we don't consider that forecast to be confirmed until the asset markets are confirming it. And we've backtested all of the different tradable assets to make sure we really understand what that means and how they trade through the various economic regimes. And so right now, our fundamental outlook is that growth and inflation are going to decline or are already declining. Mm-hmm. And the reasons for that, you could almost think of it as sort of a return to trend. Last year, call it last spring, what we were really seeing was, the reopening, right? And, we saw some really ridiculous numbers in terms of growth and inflation. We saw, real growth, real GDP growth, comp at like 12.2% in year-over-year terms. That's how we look at it. We don't look at the SARS. Which is obviously just, what is that, 10,000 basis points above trend or something like that. We saw PCE, 25, 30% year over year. And a lot of this was, comping the year the earth stood still in 2020. A lot of it was sort of induced by this fiscal stimulus that we, may never see repeated again. But that doesn't really matter. It is what it is. That's what happened. And the reality is, that's what we're going to be comping against in 2022, right? So the base effects from 2020 were really easy. And now in 2021, now that we're comping 2021, they're going to be really, really hard. So we think 2022 will sort of be defined by a return to trend. And, I think there are a couple of implications around that phrase, return to trend. The first is that, we're not seeing a regime shift of any kind. We're not seeing any kind of mean reversion in terms of rates, right? You'll hear all sorts of sort of wild forecasts around where people think rates are going to end up going. We think and ultimately, right, growth and inflation are what drive rates, along with term premium, but nominal growth is really the primary driver of long rates. I'm rambling a little bit, but we expect to see growth and inflation return to trend. We don't expect a regime shift. And we expect that return to trend to be somewhat painful for the asset markets because, as growth and inflation decline together, that generally means slower growth in nominal earnings, which is what the street cares about. And then you add on top of that the fact that we're going through a tightening cycle. And what that really means is you're getting slower earnings growth with rising risk premia. And, translated into sort of bottom-up fundamental terms, it means slower earnings growth with PE compression for stocks, which is just sort of a cocktail for bad performance from risk assets.
Okay, so a lot to unpack there. So let's kind of like go back to some of your points in terms of base effects. on year-on-year growth in terms of GDP growth and CPI growth, and I have the 10-year here as well, as you mentioned it. So one thing that you mentioned are these kind of like base effects. The fact that you just had a very soft 2020 because of the closings and all the shutdowns and business activity declined, and then you just had an acceleration because there was this year-on-year growth of an easy base here, both in terms of CPI and GDP growth. What makes you confident that outside of like the base effects, are you looking at anything else to suggest that inflation is going to moderate going forward? And I think you said is going to return back to trend. And if I kind of look here, trend should be around 2%. So kind of like, why do you think that 2% is going to be the value or the number to look for in 2022, 2023, instead of maybe some other arguments out there, or another possibility of inflation remaining high or staying elevated because of because of a host of factors? But how do you think about your view that inflation is going to moderate back to trend instead of remaining high?
Sure. So feel free to stop me if I start to go on too long about this, because obviously I have a lot of opinions on it. But you can sort of think of inflation or the price of goods and services as the intersection of supply and demand for goods and services. Mm-hmm. And obviously, we've had really hot inflation in 2021 and into 2022. And the reason for that is because supply chains have been out of whack. So you've seen, the line for supply go down, and you've had this sugar rush from fiscal stimulus, right? The 30% PCE numbers we were talking about earlier. Mm-hmm. And so you've had demand go way up and supply go way down, and that's pushed the price of goods and services higher. So in the short term, we're seeing that fiscal sugar rush wear off. We're not going to see, I don't think, any kind of meaningful fiscal stimulus in 2022 unless something really changes. And I think that'll be pretty obvious if it does. And as we said earlier, we expect 2022 to be sort of defined by a return to trend in terms of demand. So the rate of change of demand will almost certainly be going down. And then supply chains are already normalizing. And I'm not sure how consensus that view is anymore. It was super not consensus, a few weeks ago. But, if you're looking at any of the regional Fed data, the message is still mixed. Firms are still obviously feeling, high prices relative to history, but the rate of change has gotten a lot better. And you can see that in stuff like prices paid and prices received and delivery times. And most of the indications that we look at show that from a rate of change perspective, supply chain issues are easing. They're getting better, not worse. If you look at the Baltic Dry Index, mm-hmm. Which measures shipping costs, you can see it's 70% off of its highs in mid-October, which incidentally we sort of think coincided with peak supply chain tightness. So all of those forces are easy. Demand's coming down, supply should be going up, and that's against a backdrop of really challenging comps for inflation because 2021 was so hot. So we think it's very, very likely inflation comes down. Maybe not to 2% exactly. Maybe it's 3.5% or something like that, which is still high. But it's returning to trend. Directionally, that's the way things are going. And I'll also add that that's sort of my organic outlook. If the Fed over tightens, obviously that can destroy demand and, bring inflation a lot lower, a lot more quickly. Actually, if you look at 2008 and 9, actually eight, I guess, or whenever inflation peaked last cycle, pre the banking crisis, a lot of the headlines were very similar to the way that they are now with inflation, sort of in the mid 5% range. And, it was negative. It dropped like 700 basis points over the course of 12 months. Inflation can go down really fast when you get, real demand destruction. So there's obviously a big margin of error for there, but we think the margin of error sort of skews low. We think generally people are expecting, people will be surprised by the downside in inflation.
Yeah, I love that. I love that point about 2008 because in 2008 was when the ECB actually raised rates, and because they pointed to higher oil prices, and that turned out to be a policy mistake in hindsight. But kind of like inflation did go up in the middle of 2008 because oil prices kept going up. And that was, as you point out, that was kind of like one of the really short-sighted arguments of like, hey, inflation's going up, we should be tightening the economy, or we should be withdrawing stimulus. Whereas really, what was the biggest, what mattered the most was this kind of huge cliff that the world was facing in 2008, that was coming from a demand destruction caused by the credit cycle. And that's kind of a really interesting point of a comp to today, with inflation going higher. But there's definitely a slowing that's happening and a tightening that's happening, and that'll likely lower inflation. So I'd love to hear your opinion. This is something that's like a baffling me, or a conundrum for kind of me, for when I look at the market. Since 2021, and really since October here, the 2-year yield has increased. And the 2-year yield has increased because the Fed has signaled that it's going to raise rates pretty significantly. And that's sort of decreased the market's view of growth, and reduced and withdrew liquidity from the system, and really reduced the market's view of future kind of nominal growth as stimulus. At the same time, 10-year yields have been going up in sort of that environment. So if I just describe what I did before seeing 10-year yields, I would expect 10-year yields to actually either go, be flat or go down, but they've actually been increasing during this time. Like, how do you square that, or how do you explain that?
It's a great question. And the framework that we use at Invictus for understanding rates is that rates are driven by two things, and really just two things. And you could decompose it further if you wanted. But in the long run, rates are driven by nominal growth and term premium. Mm-hmm. And you could sort of think of nominal growth as the fundamentals, and term premium as the influence of the Federal Reserve on the long end, mm-hmm. right? And generally, you see term premium rise when monetary conditions are tightening. And obviously, that's when you see rates rise like they are today, there's only two reasons why. One, nominal growth is going to accelerate. Very unlikely, right? Or two, the Fed is going to tighten. And that's what they're telling us, right? So we have a pretty high degree of conviction that growth is going to decelerate, and that this rise in rates is being driven by term premium rather than nominal growth, because we can see growth declining, and because the Fed is telling us it's going to tighten. So that seems like the most logical explanation to us.
And so just for people out there, term premium is this kind of plug that people use to say, hey, we can't explain what the hell's going on, so we're going to make up a fancy word called term premium to just say that there's a premium, despite the fact that nominal growth is declining.
You have to have your CFA to use it, I think.
That's right. That's right. Do you have your CFA?
Yeah. I hate to say anything bad about the CFAI after getting it, but
right, and we have to use the CFA in the right. You have to use it as a noun, and not a, like, I can't say, do you have your CFA? I have to say, are you CFA certified? Right? Is that don't they teach you that as like one of the things in the ethics chapter?
I've tried to avoid thinking about it since the exams.
Yeah, got it. Well, maybe it's changed since I got mine in 2005 or whenever it was. Still in kind of black and white print back then. Okay, so term premiums going up. That's been driving the 10-year, kind of like saying that we don't really know why 10 years going up, even though we're pretty sure that nominal growth is going down. So like, any other, so it seems like on the macro level, you basically are thinking about mean reversion and kind of getting to a more normal level next year, driven by just base effects and driven by a restrictive Fed. Any other kind of like big picture macro views that are important to highlight?
Yeah, a few more thoughts on inflation, and feel free to chime in here if you think I'm off base on anything. Mm-hmm. I think if you're going to make a regime shift call about inflation, which tons of people are, that's like the clickbaitiest headline within finance right now is regime shift, faster inflation.
Yeah.
But I think to make that call, you sort of have to understand what's been driving the disinflation since the 1980s. Mm-hmm. And I think the causes are relatively well known, right? You've got high and rising national debt, that's deflationary. You've got demographics that are quite poor in the U.S., but mm-hmm. maybe better than the rest of the developed world, but still not good. Deflationary technology, the dollar system in general is sort of a deflationary force. So if you're going to make the case that there's a regime shift, I think you have to make the case that those things are changing, right?
Mhm.
or that COVID has somehow caused those things to change. And I think the obvious answer is that those things have not changed with COVID. I think that many of them have gotten worse, right? Our national debt is higher relative to GDP than it was before. Fertility rates went down through COVID. They didn't go up. So there's no reason to think the demographic situation is going to improve. Technology remains just as disinflationary as before. So I think that the burden of proof is on the side of the people making the inflationary claims. I'll tell you where I think, we could be wrong on this, and where you're seeing a lot of inflationary pressure today is in energy. And, energy is a huge component to inflation. And I'm sure a lot of listeners already know this, because energy, or just call it petroleum products broadly, are sort of an input cost into almost everything from building materials like, asphalt and roofing to consumer products like, plastic or lotions and other cosmetics. I mean, energy is really an input into everything. And if you look at the year-over-year rate of change in crude and compare it to the CPI, it looks almost exactly the same if you sort of normalize the axes, right? Which makes a lot of sense. So, to the extent that there is sort of a systemic energy shortage or systemic underinvestment in energy, I mean, yeah, that's a real inflationary force, right? And yeah, we've showed the statistics before in some of our research, but there's 41% fewer employees working in oil and gas today than in the cycle peak in 2014.
Mhm.
So that's one way of measuring investment, right? Energy investment has come down quite a bit since then. You can look at investment in new field machinery; it's down 61% since 2012. You can look at rig count. Rig count's down 68% since, I think it's 2014 was the peak. All these different measures of investment in oil and gas are way, way down. And so, less investment reduces supply or makes it more expensive to bring supply online. And, the obvious result of that is, incrementally higher energy prices, which pushes inflation up. We think about inflation generally in terms of a tug of war. It's sort of a mental model that we use between inflationary forces and disinflationary forces. And obviously our view is that both over the short term, call it a year, and over the longer term, call it 10 years plus, our view is that disinflationary forces are likely to win out. But there are some real inflationary forces out there, and we're seeing that in energy right now.
Yeah, and that's a great point on the input in energy. And I guess the question is the market going to pay? It's always the question is the market going to pay attention to that as a one-time kind of like a one-off, or is it going to pay as a sustainable or a sustained higher inflationary force? So just pulling up here the price of oil and the year-on-year change of oil here on the bottom. Oil's at $100 today, or give or take, depending if you're looking at crude or Brent. But if it's at $100, then where are you kind of like expecting? And it's already up 50% year on year. What is the expectation for oil for next year in terms of like the base effects that you talked about before? And sort of looking at 2011 to 2014, where oil remained at $100 for a period of 5 years. The CPI was actually falling because those base effects kicked in, and the change in the price of oil, or the percentage change, was actually flat and not rising. So that's kind of like an interesting dynamic to monitor. Is just we know that oil prices are high because of these supply chains underinvestment, but what is the likelihood that they're going to continue to march higher at the current pace, and how is the market going to look through that in terms of how sustainable they are, right?
So it's a great question, and it's a very challenging question. I'm gonna sort of do what I always do and go ahead and side with the bond market, right? So if you look at long-term expectations for inflation, you can look at the 5-year break even, or you can look at the 5-year forward. They're all, I don't want to say, I think the 5 years 2.7 or 2.8 or something like that, and the 5-year is below 2, so that's a lot lower. But essentially, what the bond market is telling you is, oil's not going to go to the moon. It's the rate of change at least will moderate, and we're going to see declining inflation in the future. And look, the bond market's really, really smart. The bond market has a better batting average than most fundamental forecasters. I'd also add that if you just sort of look at the back test, and these are sort of reflexive. So you have to take that, for what it is. But through deflationary market regimes, particularly ones where the Fed is tightening, oil backtests very poorly. So, I can acknowledge that on a technical level, oil certainly looks great. And if you're screening for technical, things like relative strength, certainly the energy sector screens very, very well. And look, I have a tremendous amount of respect for technical analysis and market analysis. But, if I were to invest in energy or, energy stocks or energy commodities, I'd be managing my risk very carefully, knowing that, like, hey, yes, the technicals look good, but the back tests look bad, right? And it's certainly not uncommon to see high oil prices late cycle. It's oftentimes the impetus for the tightening that results in significant demand destruction and acts as sort of a catalyst for a sharp deceleration in growth.
Yeah.
So maybe long story short, I'd say if you're going to go long energy, maybe run with tight stops.
Yeah. So any other kind of like macro themes you want to talk about before we get started mentioning some, and I want to kind of pick your brain on the actual trade ideas?
I mean, I guess those are the big ones. Our framework is all about the business cycle, and the two constituent cycles of the business cycle we think are the growth cycle and the inflation cycle. So, we've covered the important stuff.
Got it. And just last question, maybe, how do you think about international versus US? We talked a lot about the business cycle just now. We talked about the Fed, but there's obviously an international component. How do you think about international global growth versus US growth in your framework?
We do look at it, especially where it's of particular importance to the US. So, for example, we might look at the Chinese PPI because we source a lot of stuff in America from China. So that can give us some evidence as to the cadence of future CPI inflation in the United States. But, largely we're US focused. And that's, partially due to resource constraints, at Invictus, but it's also partly due to the fact that the global business cycle is largely synchronized with the US. Everyone pays for everything in dollars, whether in terms of international commerce or international finance. And, the world and supply chains have just become so globalized now that, and the US is so central to it all that the US is really the most important thing. Not that you can't add a ton of value by covering international, and a lot of people do. It's just not our specialty.
Got it. Okay. Makes sense. Cool. So let's go down from maybe 20,000 feet to 500 feet. And let's talk about some trade ideas. So in this environment where growth is slowing, inflation is slowing, we're in the sort of mid-cycle slowdown. What should investors do?
Yeah, so it's kind of a long process, and feel free to stop me if something doesn't make sense. But basically, our process starts with our measuring and sort of making sure we understand the business cycle and the growth and inflation cycle, and doing our back tests. So, for example, if we think we're in a deflationary market regime, we really want to be looking for ideas that backtest well through historical deflationary market regimes. That sort of gives us an idea as to the best places to go fishing, where we want to drop our lines, where the probability of success is highest. And from there, we then look for a handful of statistically important quantitative features. And this is where it's going to start to sound a little bit more like traditional market analysis or traditional technical analysis, because the tools are just so powerful, right? Trend, price trend, relative strength, which we usually look at as a ratio chart, right? Whatever security we're looking at divided by, call it the S&P or the Russell 3000 or, whatever. Mm-hmm. Maybe if it's a bond, maybe looking at the Barclays aggregate bond index. Mm-hmm. Absolute momentum, which we typically measure using RSI. But basically, I don't know if I would self-identify as a trend follower, because, we try our best to get every part of the cycle right, but, sometimes we're wrong. We certainly acknowledge that trend following is an unbelievably powerful investment philosophy. And there's a reason why so many, incredible investors are essentially trend followers. I mean, if you read Market Wizards, all the Market Wizards book, how many of those guys are trend followers? I don't know. Off the top of my head, it feels like 75% of them, a lot of them.
I would put it more as 100%. And every serious macro investor is at the end of the day a trend follower or a technician. because the economy is so complex and there's so many things that change so quickly, and because prices change before the fundamentals. If you're making a forecast on a 3-year basis and putting an investment on and coming back in 3 years, just think about everything that's changed at any 3-year period over the past 10 years. Is that you're just always following what markets are doing in terms of rates and equities and inflation and risk, and then trading based on that, because the market's going to change much quicker than the fundamentals. Sorry to interrupt you, but yes, that's if you weren't following the trends and you weren't looking at kind of like what's moving to confirm your views, then that would be a real issue, and you would not be invited back to Investing Wizards. But I think the way that you look at it or approach it of kind of like having a view of where you are and having a economic view or cycle view, but then really relying on the markets to confirm that with technical analysis and trends is really an effective way to approach it.
Yeah, that's we're sort of that mind as well. Actually, I have another macro point that you just reminded me of.
Yeah.
So if you look at the year-over-year rate of change in real GDP growth and the year-over-year change in CPI inflation, and just sort of look at it as far back as there's data, I think that's back to the 1950s on Koyfin. I'll wait a second for you, but you'll notice it looks like a sine curve, right? It's, you see trend and then peak and then trough and then trend and then peak and then trough. And the business cycle is really, really clear. So I think, sometimes when you say trend following, maybe someone who's uninformed on the topic will go like, well, that sounds too simple. How could you possibly add any value following trends? How does that not get arbed away to the extent that it does exist? And, the answer is because the business cycles or the economy cycles, right? It cycles in terms of growth, it cycles in terms of inflation, and the asset markets are reflections of the underlying economy, right? And if you don't believe that, you can't trade. If you think that markets are random or that the Fed has truly destroyed price discovery or whatever, you don't have any business being in markets, because, if the market doesn't trade on fundamentals, then why do you think you can make money?
Yeah.
You have to believe it trades on the fundamentals. It's a self-defeating argument.
Yeah. Well, and history suggests that it does trade on fundamentals. And these long-term charts are so fun to look at, because in a world, like if we were designing SimCity and it was just everything was mechanical, then the rate of change, kind of the GDP growth, would be constant, right? It would be 2%, and it would be driven by population growth, productivity growth, and then any change in money, right? The three kind of like metrics that go into long-term growth. But it's not 2 or 3% or whatever that run rate is. It sort of cycles around it because there's so many different complicated things that happen in terms of supply, demand, prices, shocks, and that's kind of like what gets the business cycle. But that's a great way of putting it. And it's a great point to kind of like zoom out and observe the sine curve and just sort of see that's the opportunity, and that's what we're trying to really understand. Let's start talking about kind of like specific themes and trades that you're thinking about.
Okay, sounds good. So we've established that our outlook is deflationary. That's sort of our fundamental view. The asset markets are confirming it, so that's an investable view for us. So the first thing that we would then do is look back at history and say, what kind of risk exposures have back tested well or poorly through deflations. And as it turns out, and then on top of that, we're sprinkling in this fiscal tightening, or monetary tightening. And so that's a pretty bad combination for risk assets. And outside of energy or maybe some things in financials, it's challenging to find all of those other quantitative characteristics that we look for. Good momentum, both absolute and relative, positive price trend. And so this is a terrible, boring answer, but on the long side, cash is probably one of our favorite long opportunities. Deflations are risk off market regimes. And so generally, if you have to have exposure to equities, you want to be taking risk off, right? So you want to be moving up the market cap spectrum. You want to be looking more at large and mega caps, less at small and micro caps. You want to be looking more at defensive sectors and style factors, maybe staples or utilities.
So
This is historically.
Yeah. So if I look at something like XLP versus XL XLY, right? That's the discretionary. So you'd be, well, it's already starting to go up. So you would be long XLP versus XLY.
Right. Exactly. So yeah, we've been, if you get our weekly trade ideas, we've been, a lot of our short ideas have come from consumer discretionary, with a bias towards sort of small and mid cap consumer discretionary. And then a lot of our long ideas have been coming from, call it large cap staples, large cap, low beta, large cap utilities, to the extent that we can find good setups.
So XLP, XLY is one. Another one would be SPY versus IWM.
Right. And that chart will look pretty good, right? That'll be an uptrend.
Okay. So this is a relative ratio that you buy. So kind of like thinking about defensives. So kind of like taking a low beta exposure, defensive versus cyclicals. You mentioned utilities. So XLU, would you be, this is interesting because let's look at, you said you look at relative strength, right? So let me just pull up relative strength of utilities versus SPY. And what would you say kind of like here's going on?
So this is interesting. This is a chart that we just made on Koyfin. If you look at the relative strength of utilities, low beta, staples, gold, they all bottomed pretty much at the exact same date. Excuse me.
Which is November 8th to 21.
Yeah, sometime in mid-November. I don't remember if you're looking at it, it's probably that. And I might have used dividend adjusted or unadjusted, but mid-November, right? Which is incidentally when we think economic activity probably peaked in Q4, right? Q4 was an acceleration over Q3. So, the perfect time, if you could time the market perfectly to get into defensives, probably would have been, November 15th or whatever the date is, around when all of these bottomed in relative terms. So anyway, but even at Invictus, as great as our research is, we're never going to bottom tick it like that. It's impossible. We're in, like we said earlier, we're sort of trend followers, right? We want to see higher lows and higher highs before we say anything is confirmed. I think we made the deflation pivot in December at some point. And so that's when we would have started looking more seriously at these defensive sectors.
And so would you be shorting anything right now?
Oh yeah, our shorts have been working much better than our longs, which shouldn't be surprising given the type of market that we're in. So, what tends to backtest poorly through deflation? Well, anything with risk. Again, you could look at the relative strength of, IPOs or ARK, ARKK, the ARK Innovation ETF, or almost biotech. Almost anything that sounds risky is just getting clobbered in relative terms. And that's because, it's unsurprisingly a sort of a risk-off regime. So that's really, we want things that are sensitive to deflationary economic conditions on the short side. And we also want things that are sensitive to tightening monetary conditions. So generally that means long duration equities. Those are, without a doubt, those long duration equities they've been our best shorts over the last, call it 2 months.
And so just to clarify, long duration equities means growth equities. So something that doesn't have a lot of cash today and is growing very quickly.
Well, yes, usually it's growth, but technically it can really mean anything where the bulk of the valuation resides in the terminal value. So sometimes you have biotechs, right, where there's no there's no financial statements really, there's no growth, but that for this business that has no revenue to be worth $3 billion, there's a terminal value. And biotech tends to be interest rate sensitive as well.
Got it. Okay, cool. And would you do you have a view on like TLT? Like if you were to, do you have a view on TLT on bonds?
Our outlook is it's bullish, right? Bonds, treasury bonds, risk-free assets tend to backtest very well through risky market regimes, which is unsurprising. And I know that the term premium answer is sort of a cop out, but when term premium reverses, when expectations for tightening begin to reverse into expectations for easing monetary policy, or else the economic environment becomes so risk off that declining growth sort of outweighs the element of rising term premium. We don't want to buy bonds. Said another way, we want to wait for a good setup.
Got it. Okay, so a couple of cross currents right now.
Yeah.
Anything else? Anything in single stock land that you've been recommending or thinking about?
Yeah. So try TWLO.
Mm-hmm.
So this is a pretty good example. Zoom out a little bit. You can see that big frowny face, the Bob Farrell frowny face.
Yep.
This was a short from Valentine's Day.
Mm-hmm.
Didn't have anything to do with Valentine's Day. That was just the day the weekly trade ideas came out.
Mm-hmm.
But this is a good example of everything that we're looking for.
This is the frowny face. I'm just going to move it down here. So this is the frowny face.
Yep.
And so So sorry. So when you came out with it on Valentine's Day, was around here?
Right. Yeah, it was like 190, something like that.
Okay. And so you're actually looking. So it's not like you're like shorting TWLO at the top here. You're actually looking for that confirmation of the breakdown. In terms of if it's around here, you're actually looking for this frowny face to form already.
If the conditions were right, maybe we would. No, honestly, we would probably never short an uptrend. To be honest.
Yeah.
I've tried it before. It doesn't work for me.
Yeah, it's really hard. I think this company is a great company from a fundamental or company perspective, but that doesn't matter because I would agree with you. This looks like a really, really bearish chart with this kind of like rounding top. I think like one of the key the key bearish points was when they released pretty good earnings and the stock popped and then gave it all back kind of like a day later. I think that sort of tells you the kind of trend it's in, and it's all a energy a premium deflation. So if we look at kind of like EV to sales on TWLO, it's not actually the fundamentals that are driving it. It's all about kind of like this multiple compression, which has to do with this regime that you've described so well, where it's risk off. It's a fleeing to more safe havens. And that's sort of what happens. And wow, I didn't realize that TWLO is trading at its the lowest kind of like EV to sales multiple that it has in history. See if not close. So since 2018, and we use TWLO at Koyfin for our infrastructure stack. So we know the product well, but great company. But maybe the valuation just got the valuation definitely got ahead of history, and now that's kind of come down. How would you, like, if you're telling investors or your clients to be short TWLO today, how would you manage that risk? How would you think about it? Is there like a stop? Is there a trailing stop? How do you manage that?
That's always I'll start at the beginning. So first, we know that TWLO has a lot of risk exposures that backtest poorly through deflations, and particularly tightening. Honestly, with tightening, that's probably the more impactful element for TWLO because it's sort of the prototypical long duration equity like we talked about. Mm-hmm. The underlying business is still growing, 40, 50% plus a year. The bulk of the valuation resides in that terminal value. So it's going to be very sensitive to tightening monetary conditions. So when you see, euro dollar futures pricing in 7 hikes goes from 0 to 7 hikes in 2022, where are you going to really see that in the market? Well, you're going to see it in stuff like TWLO, right? So the back tests are very negative given what's going on fundamentally. You can see that since basically the beginning of 2021, it's sort of been making lower highs and lower lows. Mm-hmm. If you look at relative strength, the ratio chart with the market, it looks terrible. The ratio is also making lower highs and lower lows. So weak cross-sectional momentum, as we might say. If you look at RSI, so absolute momentum using the relative strength index, mm-hmm. You can see it's making oversold readings. It's not really making overbought readings. So it's in sort of a bearish absolute momentum regime. So it's fitting all of our criteria, our trading criteria, as you can see. So now that we know, hey, weak momentum, price downtrend, back tests are bad, it's really all about finding the right setups. And when we say that, what we mean is a setup where the potential profit on the trade is multiples of the potential downside. And you can think about that a bunch of different ways, and you hear people argue about the best way to do it. You can do it with support and resistance. And, that's frequently the way that we do it at Invictus. You could do it with Bollinger Bands. The principle just has to be, you have to have some way of getting stopped out when you're wrong and letting your winner run if you're right. How you do it, I think, is honestly not quite as relevant. What matters is that you somehow implement that philosophy.
Yeah.
So I think the ideal place to have shorted Twilio is probably around 210. I mean, if you were to draw a horizontal line around 210, I think, if memory serves me, that would be a place where price is touched multiple times. You've seen the market show respect for that level. And then the downside target from there was maybe 145, something like that. So if you could have shorted it as close as possible to that 210 level, or that top line, with a downside target of 145, obviously your potential profit is very large, and you get stopped out with relatively small risk if you're wrong.
Yeah, I think like thinking about from this example, at least thinking about this kind of support level from this previous peak, from this gap, is actually a pretty good way to think about it.
There's so many charts like that. It's unbelievable. It's a challenging market. This is a great environment to be shorting stocks. Invictus has had pitching my own book, but a very good run on the short side. And it's not because we're genius at shorting stocks. It's because the environment is enabling that.
Yeah.
Right? Like, part of being a good investor is saying, hey, what's the market telling me to do, and just listening to the market. And right now the market's saying, if you have a mind to short sell, go for it. This is the time to do it. And you still have to manage your risk, and you can't lose your discipline. But if that's something that you're open to, it's a pretty decent market for that. Breadth is terrible. That's not a bad way of evaluating whether a market is good for going short or going long. If most stocks are going down, it's usually a better environment to sell short.
Yeah, absolutely. Cool. So maybe we can sort of wrap up, and maybe you can tell us, like, with your research process or research product with Invictus, what is it? How do people find you? What do you provide? Can you just give us an overview of what that is?
Sure. So as we've sort of gone over a little bit, Invictus provides, the website is invictus-research.com if you're interested in checking it out. But we provide analysis of the business cycle, and we do it through 3 products. We have a daily product called the Daily Edge, where we go over the big economic data releases from the day before and the major market moves, and sort of put them in the context of the business cycle. We have our weekly trade ideas product, where we go over ideas like TWLO, like we just did there. And then we have our monthly market outlook, which is a longer term, more strategic outlook at the markets. And all of this is sort of retail oriented in terms of the price point. Our goal is to make macro simple, to sort of dispense with all of the jargon of traditional Wall Street research, and to make it available to anyone who wants to learn about the business cycle. And the other thing that makes Invictus unique is that most of our research, except for the weekly product, is delivered over video. So we aim to make it short, concise, focus on what's important, and hopefully it's a little bit more entertaining, or at least a little bit more digestible, because it's delivered over video rather than one more boring PowerPoint presentation.
Yeah, absolutely. Well, I've really enjoyed kind of learning, finding your research and starting to read it and follow it. And I've really enjoyed this conversation, where we touched on a bunch of different things. So thank you for highlighting that. Definitely encourage anyone listening to check out Mike's the Invictus trading product or research product and sign up. How much is can you just give us a sense of the cost?
It starts at under $60 a month.
Okay, great. Well worth it to kind of give you an orientation in macro land and the business cycle. Sweet. And then before we wrap up, everything that something I ask my guests in terms of favorite TV show. Can you recommend something to our viewers that you've been watching?
Haven't been watching this recently, but Mad Men has to be the best TV show. It's absolutely the best TV show that I've ever seen. I mean, the director and creator Matt Weiner just has an unbelievable eye for detail. The show is aesthetically beautiful. It's morally grounded. It's the character arcs are super interesting. Just everything about it is super well done. That said, I know you like The Wire. I haven't seen The Wire, even though I'm sort of a Baltimore guy. So I'll have to add that to the list. I would like to find something better than Mad Men, if I can.
Mad Men is a really good one. Cool. Awesome. Well, thanks so much, Mike. Really appreciate you sharing your thoughts with us. And looking forward to having you again soon.
My pleasure. Thanks for having me, Rob. And also, I'm an avid user of Koyfin. It's an amazing product.
Cool. Thanks for that plug. All right. Have a good day.
Thanks, Rob.